Thank you. Good morning, everybody. It's really an honor to be in front of such a distinguished audience of government officials, industry, stakeholders, partners, and colleagues. I'm under the same strict rules as Philip. I have a lot of slides to show you, so I might skip through a few. But just know that you will have access to a copy of this presentation through our colleagues from Bench Events. So I'm going to give you just an overview of the Saudi hotel market based on our extensive research throughout the past 10 to 15 years, and also give you some hints in terms of how do we see the outlook in the market. And I think it's important, first of all, to base the foundation of our study. All of our research is based on our very well-renowned HVS annual Middle East Hotel Survey, which is a survey that we have been conducting for the last 10 to 15 years. It's a very comprehensive survey that basically covers a complete list of a sample of over 680 hotels, accounting to 170,000 rooms over 42 major cities in 13 countries, and covering most of the international and regional hotel operators who are very close partners. I think it's important in the beginning just to give you a high-level view of some tourism indicators, just to put things into context, and just to show you some statistics from the World Tourism Organization, WTO, on international arrivals, just to give you a hint of what is happening. Obviously, we see that in terms of the UAE has consolidated its first position in terms of international arrivals, followed closely by Saudi Arabia. And Saudi Arabia has actually, interestingly, had higher international arrivals than UAE prior to 2015, but has slightly stagnated and declined in the last 2 years. Actually, we also see in third position a nice recovery from Egypt due to the stabilization of the geopolitical situation there, and Egypt coming back into the tourism landscape as a tourism destination. And then followed by the other countries, which obviously have much lower arrivals, but I would note a 5% increase in Oman from 2016 to 17, and a quite significant drop in Qatar due to the current geopolitical situation. In terms of total passenger movement, in terms of airport statistics, I mean, you see definitely the phenomenal growth of Dubai and Dubai International Airport at 88.2 million visitors per year. And we also see actually Doha, which was actually in second position up to 2016 prior to declining due to the situation that we discussed earlier. This puts Jeddah actually in second position as the second busiest airport in the region at 34 million passengers. So these were the two things I wanted to highlight from this slide. In terms of WTTC statistics, I think it's quite interesting to see what they showcase in terms of typically direct contribution of tourism as a percentage of total GDP, and also total contribution of tourism in terms of employment in the workforce. And typically across the GCC, obviously Saudi Arabia is leading the pack with, in terms of at least a dollar figure, 23.5 billion in terms of contribution of tourism to its total GDP, and with the highest year-on-year growth in 2017. But roughly, if you look across the sample, it's roughly between 2.8 and 3.5% of total GDP. Same thing for employment. We're sitting somewhere between, at least for the biggest market, between 9.1% and 9.5% of contribution in terms of employment. I think the key message here is there still remains a good potential of growth that remains untapped as the GCC economies continue their effort to diversify their economies into and getting away basically from oil dependence and tapping the potential of tourism. Just before I start digging into the GCC performance indicators, I think it's important to explain a little bit our methodology, because obviously we have an extensive database of research that we have compiled throughout the last decade or so. And obviously this is based on actual data that we gather from the market in terms of key performance indicators. But also in terms of outlook, we make our own set of growth assumptions that are based on many factors, including macroeconomic indicators, forecast hotel supply pipeline, demand generators in terms of major infrastructure and transportation developments that are likely to induce demand in the market, and obviously government-led tourism initiatives and policies. And I would like to highlight just in terms of the pipeline, obviously sometimes we see numbers that look quite scary in terms of pipeline coming in. Based on our experience in the market, we know, especially in Saudi Arabia, in terms of the realization rate of the pipeline usually sits between 50 to 60%. So there is still, as we see a number of rooms supposedly coming into the market, there is an attrition rate that is usually due to expected delays in the market or other factors related to financing or maybe development of hotels extending their typical development schedule of 3 to 4 years. So I just wanted to put that into context. We do not hold a crystal ball in terms of making accurate forecasts, but at least based on our set of growth assumptions, we can basically have a say in terms of an upward or downward trend in the market. And obviously, our outlook does not take into account any unforeseen events in terms of volatility related to geopolitical or economic or social nature. So if you look at the GCC in particular, this is a nice chart actually that relates to you the 5-year average historic data for GCC markets along with our 5-year outlook. What's interesting to note is the record year in terms of occupancy levels in 2003 and 2007, which was basically a record year across the GCC prior to the global economic recession. But in terms of our outlook, we see that really a number of demand generators will induce additional room nights in the market in each of the GCC countries in the next 5 years. And specifically for Saudi Arabia, with the upcoming major infrastructure and tourism-led developments in the market, we believe that this will allow the kingdom basically to reach an occupancy of 66% within the next 5 years. UAE specifically has continued its drive in the market with obviously a lot of development going on to the build-up of the Expo 2020. And this global event is likely to ensure that the UAE will have an average occupancy of 75% in the next 5 years. The other countries, Bahrain, Kuwait, and Oman, will also register a rise in demand, mainly due to government-led initiatives in the market and overall policy reforms. And their occupancy outlook sits between 57% and 64% in the next 5 years. The outlook for Qatar is fairly positive despite the current situation, but this is typically linked to the infrastructure developments in the market and also the build-up to the FIFA World Cup 2022. If you look at the 10-year average outlook in terms of, and also the historical data that we have, I mean, typically the average historical occupancy levels in the last 10 and 20 years were typically around 62 to 64% respectively, with obviously the UAE over-penetrating, or let's say outperforming the GCC average by a large margin. In terms of outlook, we see that Saudi Arabia is expected to register the largest growth and with 8 percentage point increase, followed by Oman and Bahrain at plus 5 percentage points. For the UAE, despite the phenomenal growth in terms of visitation to the country, we believe that with the strong current hotel pipeline in place right now, this will result in a constrained occupancy level of 75%. If we look at the average daily rate, historical data that we have, I mean, typically we know that with the strong pipeline coming into the market and across the GCC, this will continue to have an impact on achievable ADR levels, despite the potential demand being induced by the new developments in infrastructure and tourism-led initiatives across the region. So the ADR outlook right now for UAE, Oman, and Qatar are set to remain stagnant. For Saudi Arabia, we believe that it is likely to benefit, obviously, from its recent changes in the government tourism-led policies and obviously the implementation of Saudi Arabia's Vision 2030 plan. And we see actually average rates across the kingdom are set to actually grow by 6% in the next 5 years. Bahrain and Kuwait will register further drops in ADR, and this is mainly due to an increased competition in the market, but also to the phase out of the current hotel rate cartel agreement, which is in effect by the Hotel Owners Association. Looking at 10-year average outlook in ADRs, what we see basically here, Bahrain, Kuwait, and Qatar are over-penetrating the GCC average. The outlook for Saudi Arabia, we see that actually Saudi Arabia is set to reach an ADR of $225 over the next 10 years, while other GCC countries are set to stagnate and decline mostly due to an aggressive development pipeline and increased competition. A quick overview of the GCC 5-year and RevPAR outlook. Only thing I would set is Bahrain and Kuwait expected to register a decline in RevPAR over the next 5 years, with a drop of 15% and 24% respectively, and the RevPAR outlook for Saudi Arabia, UAE, and Oman set to remain positive over the next 5 to 10 years. If we focus a little bit into Saudi Arabia, this is a very interesting chart showing you the 10-year trend in occupancy levels, and we note that there's no correlation in occupancy trends across the cities because every city is quite different in terms of seasonality pattern, its diversified demand, and the type of hotels coming into the market. But we see that Jeddah has been a key occupancy performer in the country, having really over-penetrated its 10-year average. Riyadh has consistently underperformed the country average despite the increase in demand in the market. But this is due, as we know, Riyadh suffering from an ongoing supply growth, which is really affecting performance. Medina, very stable, very steady growth rate due basically to delayed projects and lack of rooms coming into the market. And Mecca having a very fluctuating patterns due to basically new supply, sometimes visa regulations, and also delayed infrastructure. I know I'm conscious we're a bit stuck on times. Philip and Annie are stalking me, but anyway, don't worry, you'll have this, and you can always reach out to us either afterwards or later on. You'll have a copy of it. In terms of ADR, just to note here, you can see, interestingly enough, the fluctuation of ADR's levels across all cities. I would note the Mecca ADR, which has been quite healthy but inconsistent. But we note that the ADR trend for Mecca, especially in the last 5 years, has been positively correlated to its occupancy trend. Oops. And in terms of RevPAR, we see also an upward trend in RevPAR across all the major cities. And this is basically due to recovery in corporate demand and expected increase in oil prices, which will uplift hotel performance in the market. So our outlook also for RevPAR is positive, except as well we see the Eastern Province markets under-penetrating the market average. We're just running out of time. Jeddah, Riyadh, and also we'll have Mecca, Medina, but I'm not sure we're going to be able to cover it. But in terms of occupancy levels, just interesting to see how Jeddah has actually over-penetrated or surpassed Riyadh occupancy levels since 2007. And we know that Jeddah is the gateway to Muslim pilgrims and to all visitors to the holy cities of Mecca and Medina, and has a very much more diversified demand base than Riyadh, which is more corporate and government-driven. But our outlook also indicates that Riyadh is set to surpass actually its 20-year average. But we see also Jeddah is expected to continue to outperform Riyadh in occupancy levels. In terms of ADR, the only thing that I will note here again in terms of our outlook is we think Jeddah will definitely exceed Riyadh in the short and medium term. And Riyadh ADR is unlikely to reach its record levels of 2012 and 13 due to the significant supply coming into the market. And then in terms of RevPAR, this is just basically, we're inferring basically the conclusion from the occupancy and ADR outlook. Definitely Jeddah occupancy and ADR will continue to pace the market, outpace Riyadh in the short and medium term. And this is again due to the diversified demand of Jeddah. Unfortunately, it looks I'm under pressure, so I'll not be able to cover Mecca and Medina, but we do a lot of work in Mecca and Medina. I would be very happy to have a discussion with you about that because these are very important markets to all of us, especially within the Vision 2030 plan. I'm just going to conclude with this slide just to give you an overview. So this is just basically really, in terms of, there's a positive outlook. I think it's quite reasonable, but obviously this is set on our growth assumptions. And I think this positive growth outlook really depends on the planning and execution of the government tourism initiatives that are currently being talked about. And actually, we believe that this will unlock the tremendous potential of tourism and diversification in the kingdom, both domestically and internationally. Thank you.